Hello, and thanks for tuning in to CLA's Technology Tax Insights. I'm Michael DePrima, tax principal in our Denver office. Today, we'll be discussing important changes relating to the federal tax treatment of research and experimental costs under Section 174 of the Internal Revenue Code. Now, Section 174 has been around for quite a while, and the statute is going to go through some major changes here come January 1, 2022. And these changes really are going to impact organizations large and small. To help us understand and navigate these changes, I'm joined by Patrick Smith, tax principal in our Seattle office and also leader of CLA's technology industry. Patrick, thanks for joining us. And to get us started, could you give us a quick summary? What is 174 all about? And tell us a little bit about the changes that are slated to go into effect come 2022.
Yeah, thanks, Mike. Appreciate it. Normally, when a business spends money to create an asset whose life goes beyond 1 year, they're required to capitalize those costs. For example, the intellectual property that's created from R&D expenses. Section 174 allows a business to actually immediately deduct those R&D expenses instead of capitalizing them. For tax years beginning after 12/31/21, the Tax Cuts and Jobs Act changed the rules. They changed the rules that domestic expenses, R&D expenses, will need to be capitalized and amortized over 5 years. For foreign expenses, those expenses will need to be capitalized and amortized over 15 years.
Well, pretty big changes. So we're talking about having the ability currently to expense something in year one to having to amortize it over 5 years, or in the case of foreign research, 15 years. Pretty far-reaching changes there, Patrick. So I know you work with a very large number of software companies, and a lot of these, whether they're early stage or more established, they have substantial R&D expenses. What does this law change specifically mean for software companies?
Yeah, it means that they're not going to be able to take the benefit of those deductions as quickly as they used to, and could possibly find themselves in a taxable income position. For domestic businesses, that's bad, but they still get the benefit of the R&D tax credit. Where businesses who offshore their R&D really get whipsawed is it takes them 3 times longer to recover those costs, and they're not even eligible for the R&D tax credit.
Very significant. Now, these changes are slated again for January 1, 2022. Is it too early to start planning now? And what should companies be looking at from a planning standpoint over the next few months?
Yeah, they should really start looking at what their kind of cash tax situation is going to be. If they've been running net operating losses because of these current deductions, that might change. And companies that are offshoring their R&D expense, they may need to rethink their cost-benefit analysis. Does it make sense to continue offshoring when it takes them 3 times longer to recover those costs? Also start looking at those costs in a little more detail and get a little more granular. Maybe some of those costs we can carve out of 174 and make them currently deductible.
Got it. So not too soon to start planning, and there might be ways that you could lessen the blow here of these law changes.
Absolutely.
Very good. Thank you, Patrick, very much. And thank you for joining us. If you have any questions about 174 and what these law changes mean to you or your organization, reach out to your CLA advisor. Thanks so much for joining us.